Critical emergency alert. You're about to hear mind-bending news, and if I were you, I would stick around for the next 60 seconds, so strap in. This one's breaking, and it affects every single XRP holder watching right now. What just happened in the market wasn't a fluke. It wasn't manipulation. It was a real, verifiable structural shock, and it just exposed how fragile even the strongest hands can feel when volatility hits. If you hold XRP in your portfolio, what you're about to hear could completely change how you protect your position from here on out. In these truly baffling times, it is crucial that you like and subscribe right now so you don't ever miss critical drops like this. It really helps push this message to the masses, and every subscriber here is part of the Matrix Awakening movement before the system flips. You are still early. In the last 24 hours, XRP dumped within minutes to the $1.50 range before snapping back swiftly. And that violent move wasn't retail-driven. It was orchestrated by large institutional rotations, whale movements, and automated rebalancing mechanisms that only trigger when liquidity thresholds are breached. What that means is simple. Your bags just experienced a live-fire test of the new financial plumbing we've been talking about for months. At the time of recording, XRP is trading around $2.49. If you're watching later, the price may have shifted. But what matters isn't the number, it's the behavior. Because behind that sudden flash crash and rebound, something much bigger is forming, something that could reshape not just how XRP trades, but how global liquidity behaves in the next cycle. Now, before we go any further, this is not financial advice. Always do your own research and consult a qualified professional before making any financial decisions. Here's the part that few people noticed. Buried inside a recent Ripple partner memo, a section quietly referenced real-time liquidity synchronization across multi-asset rails. In plain English, that's the connective tissue between tokenized assets, bonds, treasuries, gold, and on-chain liquidity networks like the XRP ledger. These systems are being built and tested behind closed doors, and the volatility you just saw, that's the market's way of stress testing what's to come. When whales move, they don't think in charts, they think in corridors and where their liquidity can flow, how fast it settles, and what counterparty risk looks like. The sudden wick to $1.50 was a liquidity vacuum, big players pulling capital to rebalance into safe haven assets like tokenized treasuries and gold ETFs, while simultaneously redeploying into infrastructure positions like XRP, which bridge those exact same assets on-chain. That's why the recovery was instant. The moment those rebalancing orders cleared, XRP was bid back above $2 within minutes, not by retail panic, but by algorithmic buying scripts triggered across liquidity desks. This is what happens when a digital asset matures into part of the macro system. Zoom out for a second. Look at the broader picture. Bitcoin's hovering around $112,000, Ethereum's around $3,700, and gold is near all-time highs. Bonds are being tokenized faster than most people realize. The world's largest institutions are moving to real-time settlement, and XRP is positioned directly at that intersection as the bridge between old world value, gold, bonds, cash, and new world rails, on-chain liquidity, ETFs, instant settlement. That's why this dump was never really a dump. It was the liquidity handoff, the invisible transfer of control between weak and strong hands. Every time it happens, retail thinks crash, but whales see confirmation. When people saw that drop to $1.50, the immediate thought was something broke. But what really broke was the illusion that this market still moves randomly. There's a mechanic beneath it, a system of liquidity corridors linking exchanges, ETF custodians, and on-chain settlement rails. When one corridor tightens, capital seeks the path of least resistance, and XRP, by design, sits in those lanes. Think of it like bond markets. When yields spike, traders dump risk and rotate into safety. Now apply that to tokenized assets. You've got tokenized T-bills on-chain, digital gold products trading 24/7, and cross-border settlement platforms testing instant FX swaps through RippleNet. That's what caused the flicker you saw. Money moving at machine speed from speculative positions to real yield instruments and back again. Here's the bigger revelation. This is how the next decade of finance will operate. Liquidity will no longer sleep overnight. It'll pulse between assets the way blood flows through veins, and XRP is the artery that keeps it circulating. Now, midway through all this chaos, people keep asking me, where do you actually trade and track these movements? Honestly, I use MEXC. It's the exchange where I monitor real liquidity pairs and catch institutional flows the moment they flash. I'm not sponsored to say this. It's just where the data actually shows up first. If you want to explore it, the link is in my description below. It's worth setting up an account so you can see these moves as they happen in real time. No pressure, no sales pitch, just the tool I use daily. Back to the mechanics. When ETFs rebalance their portfolios, especially gold and bond funds, they often free up billions in short-term liquidity. That capital doesn't sit idle. It rotates through the digital asset rails that can move fast enough to absorb it. Bitcoin is too slow, Ethereum is too expensive, and stablecoins carry issuer risk. That's why institutional desks quietly test bridging through XRP pairs, especially against real-yield tokens like RLUSD or on-chain treasuries. What you're seeing is a macro carry trade unfolding in digital form. Rates in traditional markets are compressing, and yield is migrating to on-chain rails. Every dip in XRP price is now part of that liquidity migration, capital being repriced to match the new settlement infrastructure. The $1.50 move was a test run for what happens when institutional pipes open fully. You ready for this? Most people think they can outtrade these moves, but the truth is, you can't react faster than the infrastructure itself. The smart play is understanding the plumbing before the next surge starts. That's what keeps your bag safe when volatility hits again. If you're enjoying this content, make sure you like and subscribe to the channel. It really helps me get this message to the masses, and it's greatly appreciated. Here's what most retail traders don't see when they look at a candlestick chart. Behind every candle, there's a system of invisible pipes rerouting liquidity. The exchange supply for XRP is now at multi-year lows. Custodians are quietly moving holdings off exchange into cold storage or institutional wallets that rarely re-enter circulation. That means when volatility spikes, there's far less available supply for traders to sell into, amplifying every price swing. Imagine the market like a one-lane bridge. Only so many cars can pass at once. When a convoy of institutions tries to cross, traffic jams form. Retail panics, exits the bridge, and watches from the shoulder while the big money vehicles take the inside lane. Then when the path clears, those same institutions accelerate across, and price snaps right back up. That's exactly what we just saw with the $1.50 to $2 rebound. Now let's bring in the macro layer. ETF issuers and gold custodians are already holding tokenized versions of physical reserves. When they adjust their allocations, it doesn't just affect metals or bonds. It ripples through every settlement asset connected to that ecosystem. Think of it as a siphon effect. Gold moves, bond yields react, liquidity gets vacuumed out of one corridor and floods into another. XRP, being the settlement bridge, feels that pressure first. This is where psychology comes in. Retail investors interpret a red candle as danger. Institutions interpret it as discount. The same event, completely different response. The whales who moved hundreds of millions during that flash dump didn't exit the ecosystem. They simply repositioned for efficiency. The market punished emotion and rewarded precision. If you've been around long enough, you start to recognize a pattern. These mid-cycle purges are not random. They're phase transitions, moments where market control quietly shifts from noise traders to capital allocators. In previous cycles, that happened in slow motion. Now, because settlement is becoming instantaneous, the transition feels like a whip. Let's call this new phase rail activation. The point where settlement corridors between ETFs, gold, and tokenized treasuries begin syncing with real-time on-chain liquidity. When that switch flips, we'll see volatility that doesn't come from fear, but from efficiency. Prices will gap not because of panic, but because of throughput limits in systems catching up to instantaneous movement of value. The next time you see XRP flash crash in seconds, remember, that's not destruction, it's calibration. It's the infrastructure learning how to breathe under stress. And the people who understand that will be the ones holding when the rails go live. There's a reason every major macro portfolio is now talking about liquidity spread instead of just asset price. Bonds, equities, commodities, and now digital assets are becoming one synchronized pool, and XRP is the settlement layer connecting them, the bridge that everything else relies on when markets seize. Stay with me for what comes next, because the next section is where it all connects. How this new financial architecture ties together gold, ETFs, bonds, and digital settlement into one system, and why that means XRP's next revaluation won't come from hype, but from necessity. So here's the truth. Markets don't reward emotion, they reward comprehension. The people who just watched XRP wick to $1.50 and thought it's over missed the entire point. That move was the system. revealing its wiring. It showed you where the liquidity flows, who controls it, and how fast it resets when capital reallocates. Zoom out, interest rates are peaking, bond yields are flattening. The Fed's next move will be easing, not tightening. And that's when real assets reprice. We've seen it with gold pushing record highs, we've seen it with ETF approvals unlocking new money pipes. And we're about to see it with settlement assets like XRP, because when yield compresses in traditional markets, liquidity looks for velocity, and XRP is the fastest lane on the highway. This isn't about speculation anymore. It's about infrastructure. The same way SWIFT connected banks in the 1970s, XRP is now connecting the tokenized economy, real estate, treasuries, commodities, ETFs, all tied together through programmable liquidity. Every time a bond token settles or a gold ETF rebalances on-chain, XRP is quietly earning its place as the preferred settlement bridge. And when the dust settles from this volatility, the holders who stayed calm will own the foundation. While others chase headlines, they'll be sitting on positions built for structural revaluation. Not hype, not hope, but utility. Remember, every major transformation in finance feels like chaos in real time. It's only in hindsight that people call it the opportunity. This is that moment. The infrastructure is already turning on. The pipes are humming. The only question is whether you'll panic when the screen turns red, or recognize that red as the heartbeat of a new financial system forming right in front of you. Stay sharp, stay grounded, and protect your bags with knowledge, not emotion. Because the next time XRP moves like this, it won't be a warning. It'll be the confirmation that the rails are finally live. Comment ignition. If you watch till the end of this video, only the real diamond hands will know what that means. Stay tuned, I'll see you on the next one.